Welcome everyone to Vested Interest. This is Shane back again for their Stock Pick of the Day video. It is October 17th. We are going to take a look at Leggett and Platt, ticker LEG, out of the industrial sector. Let's jump right in. So if you want to know more about this company, check them out at leggett.com. That's leggett.com. 1883, American inventor J.P. Leggett develops the idea for a spiral steel-coiled bed spring and partners with blacksmith and future brother-in-law C.B. Platt to form Leggett and Platt. So been around since 1883, at least that's whenever they got the first idea. 1967, initial public offering of Leggett and Platt. Company begins to produce steel motion hardware for the home furniture market, allowing upholstered seating to rock, recline, and swivel. In the 70s. In 1979, this is actually the year I was born, Leggett and Platt stock listed on the New York Stock Exchange. So you've been able to buy shares in this out of the New York Stock Exchange for the last 44 years. The company unveils a new strategic direction in 2007. The company focuses on divesting underperforming businesses, improving margins and returns, and returning cash to shareholders through increasing the dividend and share buybacks. That sounds wonderful. 2012, Leggett enters the aerospace market, producing exotic metal tubing and fabricated assemblies for fluid conveyance. 2018, company enters the hydraulic cylinders market. 2019, L&P acquires Elite Comfort Solutions, a leader in proprietary specialized foam technology for the bedding and furniture industries, for $1.25 billion, the company's largest acquisition to date. 2020, that brings us up most recently to date. Today's Leggett and Platt products can be found nearly everywhere. Operations include 135 production facilities in 17 countries. The company is the leading U.S.-based producer of bedding components, automotive seat support and lumbar systems, specialty bedding foams, and private label finished mattresses, components for home furniture and work furniture, flooring underlayment, adjustable beds, bedding industry machinery. So in the automotive, aerospace, furniture, business, right? They are a manufacturing company. Again, if you want to know more about them, check them out at leggett.com. Let's keep going here. The reason we are taking a look at them, down 0.8%, so not a huge drop on the day, but thought we'd take a look at them nonetheless. This is one that we used to have in my portfolio here. Leggett and Platt Incorporated is who we're talking about, ticker LEG. Who does not like a little leg, unless it's the stanky leg, which maybe this one is, so let's keep going. Close out the day at $24.89. Looks like they're up a little bit in the after hours here, 25.03, at least roundabouts at 6 p.m. whenever I'm recording this video. 52-week range as low as $24.16, as high as $38.55, so they are right up against their 52-week low. Average volume of 1.3 million. Today's was 1.0, and you can see actually it looks like it raised up a little bit in the morning and then clear sell-off from about noon on. Market cap of $3.315 billion, a beta of 1.27, so they are more volatile than the overall market, and again, you can clearly see that volatility throughout the day here. Price to earnings ratio, PE ratio on this one is $14.64 per share, so under 15. That's nice. EPS, earnings per share, is $1.70 per share. Earnings date is coming up October 30th, so if you're interested, make sure you tune in for that one. Not this channel, I won't cover it, but they will be releasing it. You can look online for that, probably through their webpage there on that leggett.com that we saw on the previous page. Ex-dividend date is or was September 14th. Looks like they are paying out or did pay out on October 13th. So if you were to buy them now, you would be in line for their next dividend since they just paid out their last one, though you'll have to wait a little bit. And 1-year target estimate, at least according to Yahoo Finance, of $26.33. So that does not speak to much upside appreciation for the stock price, but they do see some slight upside on this one. Doesn't look like they expect it to get back to their 52-week high, though. So I like to look at statistics and look at dividend yield theory to see if there's potential value undervaluation here. To do that, we go into dividends and splits. We look at their 5-year average dividend yield of 4.29%. We compare it to their current 7.17, smoking high dividend yield on this one. Forward dividend is $1.80. Paid out on the year. They are a quarterly payer. We'll see that here. And as we said, 7.17% dividend yield on this one. Very, very high. You can see it here as well, 7.17, same number. And since it is higher than the 5-year average, that speaks to some undervaluation. But don't just go based off of that. Is the dividend covered by their free cash flow? And as we can see here, we should be if we were, and this is part of the reason I sold Leggett & Platt. Again, I did have this in my portfolio, but some of the things I looked at last time I looked at this one were concerning, and that was part of the reason that I sold out of this one. And this is one of the things that I saw that was concerning. Their payout ratio was then, and it continues to be over 100%, 104.71% payout ratio. That is not sustainable. So they have a very high dividend yield, but it is over 100% of their payout ratio. So that means they have to do something. They have to issue more shares. They have to take on more debt. They are not paying this out of free cash flow. Then maybe they have some cash on hand, but that is not a good sign overall whenever your payout ratio is above 100% on a company like this. Now, I like to get into the financials. There's a lot of good information here as well. You can find their balance sheet, their income statement. Is their revenue growing over time? Are they paying down debt? Are they taking on more debt? Are they buying back shares? A lot of good information on here. Is their assets over liabilities look good? You want to make sure they have plenty of assets over liabilities. Are their assets growing and their liabilities decreasing? That would be a good sign of a healthy company. You want to look at all that information. We're going to look at free cash flow because we want growing free cash flow, because that's what dividends are paid out of, and we want growing dividends over time. 2019, they were paying $524,900 million here. 2020, 536 million. So a little bit of a jump up in 2020, a big drop, and I mean a big drop in 2021, 164 million, down from 536. The repurchase of shares definitely does not account for that. Back up again in 2022, up to 341 million, but not back to where they were in 2020. And it looks like, at least here in 2023 to date, it looks like they're going to have higher than 2022, but does not look like they will get back to their 2020 numbers. Overall, from 2019 to date, they do not have growing free cash flow. That was another concern that I had. So elevated payout ratio, do not have growing free cash flow from 2019 to date. Not good in my opinion, but let's keep going and see what else this one has to offer. And this information is brought to you by Yahoo Finance, one of the sources I like to go to, and I always recommend more than one source. So another one that I like is stockanalysis.com. You pick any sources that you want. Just make sure you're looking at more than one so that you can make sure the information you are getting is accurate and that it is up to date. So according to the 3 stock analysts, they have taken a look at it from Stock Analysis. They call it a consensus hold. And again, I would definitely say it's a hold, if not a sell on this one. I did sell out of this one. Again, very concerning with the elevated free cash flow, and it has been elevated for a while. I did watch it for a couple of quarters before I sold out of it here last year. So to be still elevated out of the free cash flow is concerning to me. It should be concerning to you if you are a owner of this one. But they have a low estimate of $21 here, which would be a 15.63% decrease from where it currently sits. They have an average estimate of $27, which would be a 8.48% increase, and they have a high estimate of $34, which would be a 36.60% increase from where it currently sits. All the while, you could collect that 7+% dividend yield. That is, if they were not to cut it, which I believe this company is in jeopardy of having a dividend cut. Now let's look at statistics. I like to look at return on equity and return on invested capital. I like 10% or better for both. This is really not that bad. Return on equity, 14.2%, above the 10% I like to look for. Return on invested capital, 9.60, a little bit lower than the 10% I like, but not egregiously so. So I could give them a pass on that one, though I would like it to be a bit higher. I also like to look at earning per share growth estimates. I like 5% or better. This is another one that concerned me whenever I looked at this a while back. Negative earnings per share growth. Whenever you have declining earnings per share, that is not a good thing, right? They do have a positive revenue growth forecast, but only of 1.38%. Not a good sign there either. So they don't see much growth in this one, which you would want to have higher or elevated free cash flow payout ratios right now. You would really want the revenue growth and the EPS forecasted growth to be growing so that there would be potential for that delta, that payout ratio to start coming down some. But that is not the case here. So again, that is concerning to me. Let's look at the dividend. So you can see, again, quarterly payer, they do have the payout ratio elevated. They say 108%. We saw 104% from Yahoo Finance. So we'll just call it, over 100%. Either way, it's not good. Dividend growth, they're saying 4.65. That's not sustainable if their payout ratio is over 100%. Not good there. So they do say they have dividend growth, but I would not expect that to continue if this payout ratio remains elevated. Now, I went back to 2020, they were paying 40 cents. 2021 in June, they raised it up to 42 cents. June of 2022, they raised it up to 44 cents. And they did raise it in June of 2023 up to 46 cents. But again, I don't know why they're doing that. If their payout ratio is so elevated, they should pause it and possibly pay down some debt, bring this payout ratio down a bit. But a little concerning to me on this one. I do like that they pay out January, April, July, October timeframe. Not a lot of companies pay out in this January, April, July, October timeframe. So that's part of the reason I picked them up. Plus, they are a dividend aristocrat. They've been paying out for a long time, been around since the 1800s. I think as long as people are buying cars, buying beds, and that sort of thing, the aerospace portion of their business, I'd have to do more detail on a deep dive on that to see what that's about. Maybe that presents some more growth for this one going forward. I am a little concerned with this one. That's part of the reason I sold out of it. Hey, if you are a leg investor, drop a comment down below. Let me know what you're doing with this one. Are you holding it? Are you adding to it? Are you looking to sell, or have you sold? I'd be interested to know your thoughts. This is the vested interest stock screener. This is how I set up the videos, as well as how I look at a company on a high level to see if I'm interested in investing. Just because it meets 5 of the 8 does not mean I'm going to invest. It just means that it goes into the pile of ones that I'm interested in, doing more of a deep dive, looking at the financials, looking at the company's outlook, seeing where they're at. If it's a company like a bank, a financial company, it must meet 6 of 9. You can pause this and go through this at your leisure. And that is it for this one. Let me know what you think of leg. Is it one you're investing in, or is it one you're avoiding like the stank leg? Who knows? Let me know. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up. Ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community, building a community of like-minded dividend growth investors so we can share our experiences. Stocks like this that we may be investing in, ones that we may be avoiding, or ones that we are watching and throwing on our watch list to see how they do over time and do more of a deep dive on them. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Leggett Platt you'd like me to add to the stock pick of the day series, I will work it in the rotation. Drop it down below. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. Should never invest in any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.